Breaking news. As we speak, the global financial scoreboard is flashing a number that wasn't supposed to appear for another decade. Silver has just breached $95 an ounce. While the mainstream media remains obsessed with political theater and fleeting celebrity scandals, the most suppressed, undervalued, and manipulated asset in human history has just grown a pair of wings. We are officially one trading session away from the triple-digit psychological barrier of $100. But here is the terrifying reality. The official price you see on your digital ticker is a lie. It is a paper-based hallucination designed to keep the masses calm. If you want to actually hold the physical ounce of silver in your hand today, the price isn't 9.5, it is closer to $170. Tonight, we are pulling back the curtain on a coordinated global scramble. From the high-security vaults of the U.S. Mint to the aggressive trading floors of the Shanghai Gold Exchange, the smart money is no longer just buying silver and hoarding it like a strategic weapon of war. Why did the U.S. Mint just hike its prices by 86% overnight? Why is China paying a massive premium over Western markets? And what does a geopolitical dispute over a frozen island like Greenland have to do with your retirement fund? Welcome to the endgame. The paper ceiling is cracking, and the mother of all breakouts is no longer a theory, it is a runaway freight train. To understand where we are going, we have to look at the raw, unfiltered data of the last 48 hours. The numbers do not lie, even when the bankers do. In the last trading session, silver surged over 5%, outperforming gold nearly 3-1. But the real story isn't just the price, it's the gold-silver ratio. For 15 years, silver has been treated as the undervalued stepchild of the precious metals world. That era ended this week. The ratio has plummeted below 50, a historic pivot point that signals the industrial and monetary the demand for silver is decoupling from the rest of the market, the Shanghai divergence. While the COMEX in New York is desperately trying to hold the line at $95, the Shanghai Futures Exchange is already trading at $103. This is an $8.50 premium per ounce. In the world of high finance arbitrage, that is an ocean of difference. It tells us that the East, China, and the BRICS nations knows the physical supply is vanishing. They aren't interested in paper contracts. They are taking physical delivery at any cost. The U.S. Mint telegraph, the most shocking event, however, didn't happen on a trading floor, it happened at the U.S. Mint. They halted sales of Silver Eagles under the guise of repricing. When the website came back online, the price for a proof Silver Eagle hadn't just gone up by a few dollars. It jumped from $95 to $173. Think about the implications. The government's own mint is effectively telling you that a 1-ounce coin is worth $173, while the market spot price says $95. This is the government telegraphing exactly where they expect the spot price to be in the very near future. They are front-running their own market because they know the paper manipulation can no longer hold back the physical reality. To truly grasp the gravity of $95 silver, we must analyze the triangle of conflict, geopolitics, the industrial vacuum, and the technical breakout. The geopolitical weaponization of silver. Notice the headlines, gold and silver prices jump on Greenland dispute. You might ask, what does a massive block of ice have to do with silver? Everything. Greenland is the new frontier for critical minerals. As the trade war between the US and China escalates, and the threat of aggressive tariffs looms, the battle isn't just about microchips anymore. It's about the raw materials required to build the modern world. China has dominated the silver processing chain for decades. By maintaining a premium price in Shanghai, they are effectively vacuuming silver out of Western vaults. This is economic warfare in its purest form. If the US loses access to physical silver, the Green Revolution, the electric vehicle industry, and the military-industrial complex all grind to a halt. You cannot build a Tomahawk missile or a solar panel without silver, period. The industrial vacuum and the Tesla factor. Robert Kiyosaki recently dropped a bombshell. Tesla is struggling to source silver. Think about the irony. We are told the future is electric, yet the very metal required to conduct electricity in EVs is being treated like a Tier 3 commodity. Silver has been officially designated as a critical mineral for 2026. This isn't just a label, it changes the legal framework of how silver is traded. There is now serious talk of the US government installing a minimum price floor. Why would they do this? Because they are desperate to stimulate domestic mining. They know the shortage is no longer coming. It's here. When the government guarantees a high price, it's a confession that they can no longer rely on the open market to provide the supply they need for national security. The mother of all cup and handles. For the technical analysts, the 46-year chart is screaming. We are witnessing a formation that hasn't been seen in nearly half a century. We have had a massive corrective phase, the cup, followed by a long period of pessimistic consolidation, the handle. We have just broken through the neckline of a 40-plus-year resistance level. In technical terms, when a dam that is held for 40 years breaks, you don't get a leak, you get a flood. This is why institutional analysts are moving their price targets from $100 to $114, and some are eyeing a gap up directly to $170 to match the U.S. Mint's internal pricing. The retail squeeze and the dealer gatekeepers, if you think you can just wait for a dip to buy in. Look at what the major dealers are doing. APX, the giant of the industry, just instituted a $500 minimum for online orders. Their shipping is delayed. Their mints are behind. This is the classic liquidity squeeze. The big boys, the hedge funds and central banks, are moving to the front of the line. By raising minimums and premiums, they are effectively pricing out the retail investor. They want the public to stay in the paper markets, where the price can be manipulated with a keystroke, while they back the trucks up to the physical vaults. We are seeing a mass migration of capital. The crypto bros who used to mock boomer rocks are now rotating into silver as the Bitcoin-silver ratio collapses. Even the U.S. Mint is hoarding its own supply, doubling prices on coins they already have sitting in their vaults. It's not that the silver became 80% more expensive to make in a single week, it's that the US dollar became 80% less valuable in its ability to command that silver. So what is the endgame? We are entering what traders call the parabolic phase. When assets go parabolic, logic and traditional valuation models go out the window. We've seen it with Bitcoin, we've seen it with Nvidia, and now it is silver's turn. If silver hits $114 by next week, as the current trajectory suggests, we aren't just looking at a price increase. We are looking at a teleportation. The paper market, the COMEX, and the LBMA will likely break entirely. We will move to a physical-only market where the price is whatever the person holding the silver says it is. The world is finally waking up to the fact that you cannot print silver. You cannot bail out a physical metal shortage. You have to dig it out of the ground. And the world simply isn't digging fast enough to satisfy the hunger of the digital age. The U.S. Mint has already shown you their cards. They are pricing silver at $173 today. China is paying $103 today. The $95 spot price is the last gift the market will ever give you. My question to you is this. When the paper ceiling finally shatters and silver teleports into the triple and quadruple digits, will you be holding a receipt for a paper contract that might be settled in devalued cash? Or will you be holding the physical metal that the most powerful empires on Earth are currently fighting a silent war to possess? The clock is ticking. The era of cheap silver didn't just end. It was executed by the reality of supply and demand. Don't forget to like, subscribe, and hit that notification bell. We are tracking this silver explosion minute by minute. Let us know in the comments, is $1,000 silver a pipe dream, or the inevitable destination of a broken financial system? Stay sharp, stay physical. We'll see you in the next update.
On December 5, 2025, Reuters did something that made all of Wall Street hold its breath. They dropped a bombshell article labeling gold's rally as bubble behavior. Their message was crystal clear. Prices have risen too fast, 60%, the highest performance in 46 years. Sell now before it crashes like it did in 1979. According to conventional logic, when this news hit the wires, combined with rising U.S. Treasury yields, gold should have nosedived. Investors should have panic sold to lock in profits. But the unthinkable happened. Gold didn't crash, it didn't even blink. It swallowed that bad news whole and stubbornly continued moving sideways at all-time highs. This isn't resilience. This is a terrifying anomaly. Why would an asset labeled a bubble by the media and being net sold by ETFs refuse to go down? Has the market gone insane? Or is there a shadow force silently scooping up every single ounce the moment it hits the floor? Welcome to Financial News. Let's rewind the tape and dissect this crime scene. We're going to find out why the old laws of supply and demand are dead. Look at the data Reuters accidentally exposed but didn't explain in depth. They call this a bubble. But bubbles are usually driven by retail mania, the euphoria of the crowd. But look at this chart. Gold holdings in ETFs like SPDR are 10% lower than their 2020 peak. Gold miners' stocks are still languishing at the bottom. What does this mean? It means the retail crowd, people like you and me, are not buying. In fact, Wall Street is selling. So the billion-dollar question is, who is buying, and how aggressively are they buying to absorb the selling pressure of the entire Western world? The answer lies in the vaults of central banks. According to Goldman Sachs, these whales have been net buyers of over 1,000 tons of gold annually for the last 3 years. But here is the detail the mainstream media ignores. They aren't buying on the public futures exchange, where you can see the volume. They are operating in the opaque over-the-counter markets in London and Switzerland. This is a stealth operation. By keeping their massive buy orders off the public order books, they prevent the price from exploding too early. They are using iceberg orders, buying massive amounts of physical bars while the public price, determined by paper contracts, stays suppressed. Compare this to the China silver dump. When the London market ran out of silver, China had to flush their stockpiles to save the price. But with gold in 2025, the situation is the exact opposite. The West is trying to suppress the price using news and derivatives, paper gold, but the East, China, Russia, India, is standing underneath, catching every single bar of physical metal. This is a reverse squeeze. On the COMEX, for every 1 ounce of registered physical gold, there are now hundreds of paper claims trading against it. It is a game of musical chairs played with dynamite. When the music stops, there won't be enough chairs. They are draining the physical liquidity. Reuters calls it a paradigm shift, but the accurate term is the depletion of Western inventory.
Why are they hoarding so frantically? Why don't they trust the dollar anymore? Let's look at the death spiral mechanism that the article only cautiously hinted at. Reuters compares 2025 to 1979, but this comparison is mathematically flawed. Phase 1, 1979, U.S. debt was only 30% of GDP. Paul Volcker could raise rates to 20% to kill inflation and save the dollar. Phase 2, 2025, U.S. debt is 4 times higher than in 1979. Budget deficits are running at 6% of GDP annually. Here is the deadly trap. If the Fed raises rates to stop gold, the U.S. government goes bankrupt because it can't pay the interest. If the Fed cuts rates to save the government, inflation explodes and gold goes to Mars. This is no longer just about economics. It is geopolitical warfare. Daniel Oliver from Myrmikan Capital pointed out the exact moment the system broke, the 2022 seizing of Russian reserves. When the U.S. weaponized the dollar, they sent a signal to every sovereign nation: your savings are only yours if we agree with your politics. That shattered the trust that took 80 years to build. You can't print trust. Once it's broken, the flight to safety becomes a permanent migration, not a temporary trade. The Fed's balance sheet is bleeding because it's stuffed with long-term bonds that have lost massive value. Their gold coverage ratio is now only 16% of their liabilities. Think about that. The entity issuing the world's reserve currency is technically insolvent on a mark-to-market basis. Do you see the parallel with the silver market? In silver, it was a physical shortage due to industrial demand, solar. In gold, it is a shortage of trust due to fiscal collapse. The U.S. cannot print more gold. They can only print more dollars. And the central banks know this. They are exchanging paper that is about to lose value for the only real asset left: They aren't buying for profit, they are buying for survival. So, what is the next scenario? Look at the math, because math doesn't lie. Currently, the gold price is rising solely due to smart money, the whale, buying pressure. The crowd, the retail, hasn't even joined yet because they believe articles like Reuters claiming this is a bubble. And here is the psychological trap. The article wants you to look at the nominal price, $3,000, $3,500, and think it's expensive. But priced in purchasing power, priced in gallons of oil, priced in hours of labor, gold is still cheap. The bubble is in the currency you're holding, not the metal you're watching. But what happens when Western inventory runs dry? Just like silver, when the vaults in London are empty, price will no longer follow any technical analysis. When individual investors realize bonds are no longer safe and stocks are too risky, they will stampede into gold. But at that moment, who will sell to you? The central banks? No, they're buying. The ETFs? They've been net selling for 3 years. Their vaults are emptying. We're facing a supply shock on a global scale. Reuters calls it a paradigm shift. I call it a repricing. Gold isn't rising. The value of currency is free-falling to its true value, zero. Don't let the headlines fool you. They scream bubble to shake the tree, to scare you into selling the little gold you have left. Don't sell your insurance when the world's financial house is on fire. The physical supply shortage is about to be exposed. I am monitoring the inventory data at COMEX and LBMA closely. There are signs that we are scraping the bottom of the barrel. If you want to receive an early warning alert when the physical squeeze signal officially triggers, comment "Gold Squeeze" below. Remember, in this game, you cannot use policy to fight math, and the math is on gold's side. There has been an unwritten rule on Wall Street for the past 40 years. Silence on a Friday evening usually signifies settlement. Positions have been closed, risks have been hedged, and the bankers have left their offices to enjoy the weekend. But this weekend, that silence carries a completely different tone. It is the calm before a Category 5 storm. Last Friday, we witnessed a technical black swan event. According to the standard script, silver prices are always subjected to automated selling pressure during the final session of the week to crush the momentum of the bulls. But this time, that script was torn to shreds. Instead of collapsing, the market accelerated and closed at the absolute highs of the week, $67.14. Let that number sink into your trading psychology, $67.14. For the retail investor, this is good news, but for the risk management departments at the major bullion banks, this is a liquidity disaster. They are currently trapped with billions of dollars in net short positions that are deeply underwater while the market is closed. They are locked in a panic room with no exit for 48 hours. In today's deep dive report, we are going to dissect this event. We will analyze why this closing price is not just a number, but the fuse that will trigger a massive chain of margin calls come Monday morning. To understand the severity of this, we need to look at the market microstructure. When a market closes at the highs of the week, it sends an incredibly powerful signal. The buyers accepted market orders at any price, right down to the final seconds. This indicates that smart money currently fears the risk of not owning the asset more than they fear the price risk itself. Put yourself in the shoes of a market maker who is short silver in the $64 region. Their quantitative models predicted a drop to $60 so they could cover and take profit. But reality forced the price to $67.14. Their unrealized loss is currently sitting at over $3 per ounce on a volume of millions of ounces. But we must also address the elephant in the room, the options market and gamma exposure. At $67.14, we have pushed deep in the money, ITM, for a vast array of call options that were previously written off as worthless. This forces options dealers into a gamma squeeze. As the price rises, dealers, who must remain market neutral, are mathematically forced to buy more of the underlying futures to hedge their exposure.
It becomes a feedback loop from hell for the shorts. They aren't just fighting the trend, they are fighting the mathematics of the derivatives market itself. Furthermore, we must anticipate the reaction of high-frequency trading algorithms. These black boxes thrive on momentum ignition. A gap opening above $67.14 will trigger automated buy programs before a single human trader has had their morning coffee. These algorithms do not care about valuation, they only care about velocity. They will pour fuel on the fire, exacerbating the move in milliseconds. And here is the fatal issue: variation margin. Typically, these losses are settled in cash at the end of the day, but Friday's price shock was too massive and too fast. It blew through the credit lines of many hedge funds. On Saturday morning, while the market was closed, margin calls were sent out. The demand is simple: post additional collateral before the Asian Open on Monday or face forced liquidation. And when a short fund faces forced liquidation, the computer system executes only one command: buy back at any price to close the position. This creates a classic short squeeze scenario. On Monday morning, we may not see buying power from natural demand, but buying power born from the panic of financial institutions trampling over each other to exit.
However, the financial story is just the tip of the iceberg. The submerged part, and the most dangerous part, lies in the dislocation between the paper market and the physical market. We are witnessing a record-breaking arbitrage spread. In New York, COMEX, silver is at $67.14, but in Shanghai, SGE, silver is trading around the $72 mark. A $5 spread in the commodities market is a massive figure. It creates a vacuum effect. Any silver bar that can be moved is being packed and shipped from London and New York to China. The West is suffering a physical liquidity drain. Why? Because industrial giants like Samsung or Tesla cannot operate production lines using futures contracts. They need real metal. They are executing off-market deals, securing supply directly from the mines, bypassing the COMEX entirely. Furthermore, we are hearing reports of a quiet run on the bank regarding unallocated accounts. For years, banks have sold paper claims on silver they do not fully possess, a fractional reserve system. But now, high-net-worth clients and family offices are demanding conversion to allocated status. They are asking for the serial numbers. They want the bars moved to a segregated shelf. This forces the banks to show their hand. If they don't have the metal, they must go into the open market and buy it immediately to satisfy the client and prevent a default event. This internal squeeze is invisible to the public, but it is the primary driver of the desperation we are seeing. The consequence? The spot price on your screen is slowly becoming a virtual reference. It no longer reflects the true cost to possess the physical metal. Registered inventory, metal that meets delivery standards, is depleting at an alarming rate. We are approaching 0 hour. When the Asian markets open, the most probable scenario is a gap up. The price could open directly at $68.50 or $69, skipping the intermediate levels entirely. However, as professional investors, we must keep a cool head. Extreme volatility always comes with risk. Here is the battle plan for the upcoming session: patience in the face of a gap up. If the market opens with a massive gap to the upside, do not FOMO. In theory, the price often tends to return to fill the gap, to test demand. Watch the support zone at $67. Beware the shakeout. Understand that the institutions know the retail psychology. They may engineer a sharp, violent drop, a rug pull in the early hours to trigger stop losses and flush out weak hands. Do not mistake a liquidity flush for a trend reversal. Monitor the psychological level of $70. This is not just a round number, it is the last bastion of the bears. If the price decisively breaks $70, the technical model shifts to a parabolic state, vertical appreciation into the price discovery zone. Focus on real assets. In an environment of elevated counterparty risk, holding physical positions is the optimal defensive measure. In conclusion, Friday's closing price of $67.14 is not the destination. It is the siren signaling the collapse of the old price control algorithms. The bank's liquidity nightmare is becoming a historic opportunity for investors who are prepared. I will continue to update you on capital flow developments as soon as the session begins. Thank you for watching.
They want you fixated on gold. They want you dazzled by the record-breaking numbers on tonight's financial news. It is a perfect magic trick. But while the crowd is busy chasing the glitter of gold, down in the vaults of the London and New York exchanges, a real bleed is taking place. Silver isn't just rising in price, it is physically vanishing from the system. This isn't about numbers on paper. The world is running out of the one metal that powers the green economy and the modern war machine. Today, I won't give you empty hype. I'm going to open the macro data files and analyze supply and demand to prove to you why we are facing the decade's largest structural imbalance. Welcome to the Strategy Report. Let's get into the data. To understand why silver is the most important story right now, we need to ignore the short-term noise and look at the big picture. Against a backdrop of escalating geopolitical tensions and global monetary policy uncertainty, the precious metals complex has recorded superior growth. However, there is a distinct divergence. While gold is successively setting new all-time highs due to frantic buying from central banks, silver is quietly forming a much more strategic price setup. My thesis today is clear. Silver is currently irrationally undervalued relative to its fundamentals. Let's start with the first macro factor, the safe haven role. Tensions in the Middle East and Eastern Europe are no longer isolated news events. They have become persistent risks. In this environment, smart money always seeks out hard assets. Although gold is the top choice for sovereigns, silver plays the role of a high beta safe haven. History proves that when gold rises 1%, silver tends to rise 1.5 to 2%. The second macro factor is monetary policy. The market is pricing in the probability that the Federal Reserve will be forced to ease to support the economy. When the tightening cycle ends and the dollar shows signs of weakness, that is the strongest tailwind for silver prices. But that is just the tip of the iceberg. The real story lies in the next section, supply and demand. Unlike gold, where most supply is stored in vaults and recirculated into the market, silver is an industrial metal that is consumed and extinguished. This is the key point that Wall Street often ignores. On the demand side, we are witnessing a shock from the energy transition. Silver demand no longer depends on jewelry or photography like in the last century. The current driver comes from the green economy. The solar industry is booming with next-generation battery technologies like TOPCon and HJT, which require a much higher silver content to achieve optimal conductivity. Add to that electric vehicles and artificial intelligence. You cannot run an AI data center or a guided missile system without high-quality semiconductor components, where silver is an irreplaceable material. But on the other side of the scale, supply is facing serious challenges. Here is a fact few people know. About 80% of global silver supply is merely a byproduct of copper, lead, zinc, and gold. What does this mean? It means silver supply is extremely inelastic. Mining companies cannot simply increase silver production when the silver price rises. They only dig up more silver when the demand for copper or zinc increases. Furthermore, we must address the CapEx crisis, capital expenditure, in the mining sector. For the past decade, under pressure from ESG mandates and low commodity prices, mining companies have drastically underinvested in exploration and development. They have prioritized stock buybacks over digging new holes. Here is the harsh reality. It takes, on average, 10 to 15 years to take a mine from discovery to production. Even if the price of silver doubles tomorrow, new supply cannot come online until the mid-2030s. We are facing a supply cliff that no amount of money can bridge in the short term. The geological reality is colliding with the industrial necessity. Data from the Silver Institute shows the market has experienced a supply-demand deficit for 4 consecutive years. This deficit is gradually eroding the visible stockpiles at COMEX in London. We are draining the final bars out of the vaults. So where is the opportunity? A professional investor doesn't look at price, they look at relative value and market structure anomalies. The East-West arbitrage. There is a critical anomaly occurring right now that demands your attention, the Shanghai premium. While Western markets trade paper silver, futures contracts to set the price, Eastern markets, specifically the Shanghai Gold Exchange, are trading for physical possession. We are seeing silver trade in Shanghai at a premium of 10% or more over the COMEX price in New York. This arbitrage window is a flashing red signal. It tells us that while Western hedge funds are shorting paper contracts, Eastern buyers are draining physical inventory. The smart money in the East is willing to pay significantly more to secure the metal now. This flow of metal from West to East is tightening the physical float to a breaking point. When the COMEX vault runs dry, the paper price will have no choice but to gap up to meet the physical reality. Now, let's look at the gold-silver ratio. Currently, this ratio is hovering around 85. That means it takes 85 ounces of silver to exchange for 1 ounce of gold. Let me give you some context. The average in the 20th century was only about 47. This indicates that silver is absurdly cheap compared to gold. According to the law of mean reversion, if the precious metals market continues its uptrend, silver has an upside potential many times greater than gold to narrow this gap. Regarding market sentiment, the Commitment of Traders report shows that large funds are holding net long positions, but they have not reached extreme levels. This is very positive. It means the market still has plenty of room for new money to enter without fear of being overbought.
However, as responsible investors, we must look at both sides of the coin. What are the risks? The biggest risk is a full-blown economic recession. Since over 50% of silver demand comes from industry, if factories close and manufacturing demand drops, silver prices will face pressure in the short term, unlike gold, which is a pure defensive asset. Additionally, if the Fed maintains higher for longer interest rates to fight inflation, the strength of the dollar will be a headwind hindering price appreciation. To summarize, based on the convergence of macro and micro factors, my strategic view on silver is bullish in the medium to long term. We are standing before a perfect storm. Monetary demand is supported by geopolitical instability. Physical demand is driven by the irreversible green industrial revolution. Meanwhile, supply is constricted by a decade of underinvestment and cannot react quickly. We are witnessing a gradual decoupling between paper silver prices and physical reality, evidenced by the widening Shanghai premium. As stockpiles continue to drop to alarmingly low levels, the pricing mechanism will be forced to reflect the true scarcity of this metal. My advice? Watch the inventory data and the arbitrage spreads closely. Do not let short-term price fluctuations deceive you. When the monetary system shakes, gold is the shield, but silver is the sword. Thank you for watching this report. See you in the next analysis.